morning, everyone. I hope you have a great day. So, today we're gonna start to read Article 2. So, the name of Article 2 today is Advantages of Algorithmic Trading. So, let's begin. Algorithmic trading brings unique strengths of computer system to trader that traditional trading does not have, taking advantages of the algorithmic potential can dramatically change investment performance. The law of large numbers. In probability and statistics, the law of the large number states that if the same experiment is repeated independently a large number of times, the average result must be close to the expected value. Alternatively, even with the random and unknown events, a sufficiently large number of attempts could lead to a stable average result. The law of large number can be illustrated by rolling the dice. The probability of the occurrence of all signs 1, 2, 3, 4, 5, and 6 is the same. Therefore, the expected value of the dice roll event is the sum of 1 to 6 divided by 6. So the result is going to be 3.5. If one only rolls the dice a few times, the average value of the result might be far off from this expected value. For example, roll the dice 3 times and the results are 6, 4, and 5 respectively. The average value is thus 5. However, according to the law of large numbers, if one rolls the dice many thousands of times, the average result will come closer to 3.5. In trading, the winning or losing results of a handful of transactions can occur randomly and unpredictably. According to the law of the large numbers, the results from a small numbers of trading orders are not sufficient to judge its effectiveness. However, if there's a reasonable trading strategy with a winning expectation over 50% across a large number of trades, then on average it will generate profits in the long run even though there might be a periods of consistent losses. Moreover, these results can be used as tests to evaluate a trading strategy performance. In practice, there's a big issue when applying the law of large number to real-life trading. It's often difficult for investors to ensure all transactions are sufficiently consistent according to predefined strategy due to the following factors: effects of psychology and emotions, risks such as mistake in placing orders, or slow reaction time that leads to missing buy or sell opportunities, unable to place orders according to the predefined strategy due to irregular price monitoring. Because of these issues, the results obtained can be far from the initial expectation despite an effective trading strategy and a sufficient large number of trades. More importantly, it's impossible to assess whether this result is due to a low-performing strategy or poor execution. An algorithmic trading system can solve these problems. It ensures the application of the law of large numbers, minimizing the impact of undesirable factors. Investors only need to focus on building, evaluating, adjusting, and improving their strategy to create stable long-term profits. Ensure investment consistency and eliminates emotional interference. In stock trading, beside a clear strategy, Emotional management is a key factor of investment results. Investors are often swayed by emotions and make decisions contrary to their investment principles and strategies. For example, before the 2008 global financial crisis, the market signaled that a crisis was imminent. Yet, a lot of investors ignored these signs because they were caught up with the frenzy uptrend momentum in the market. Few thought a crisis was likely to happen. Algorithmic trading solved this problem by ensuring all trades following the predetermined sets of rules and strategies. It eliminates the emotional influence of trading altogether. A simple example is the 7% stop loss principle, common among Vietnamese investors to avoid big losses. However, very few investors actually carry out this trading principle. They often keep holding onto falling stocks even when the price has fallen too low. A trading algorithm will help investors avoid this. A stop-loss strategy does not guarantee good results, but it does ensure consistent investment principles, increase confidence, and reduce stress and insecurity when investing. There are random, unpredictable events every day. They are out of control, yet have direct impact on the market and stock prices. These events require investors to make a decision to buy, sell, or keep holding. Making an informed decision gives most investors ambiguity, stress, anxiety, and insecurity. The algorithmic trading system is not a magic wand that can tell the future and ensure all trade decisions are correct. However, it is an automated system that quickly reacts to random events that can happen without human interventions. Investors only need to set up periodic reviews, monthly or quarterly, to evaluate an algorithm performance. They can make necessary adjustments and upgrade to optimize profits. This mechanism boosts investor confidence and reduces stress because there's no need to be hands-on every day. Minimize market impact when trading large volumes. A high volume transactions from institutional investors, hedge funds, or major shareholders can dramatically change the market equilibrium. To avoid this, investors usually split their orders into several small volume trades. For example, if you would like to buy 5 million shares of FPT, investor can divide it into 1,000 orders, each at 5,000 shares per orders every 5 minutes. After 1 hour of this execution, the investor assesses the impact of the orders on the stock price. If the share price doesn't change much in the unfavorable direction, keep following the same strategy and check in on the price every hour until reaching the target of 5 million shares. However, there's a time disadvantage to this strategy. In this example, even under favorable market conditions, it still requires at least 83 hours or 20 trading sessions to complete. An algorithmic trading system solves this problem by simultaneously calculating the volume and making the stock purchase. It also checks the market impact immediately to significantly reduce the number of buy orders and the time required. Save time. A complete algorithmic trading will ensure full execution of the investment process without any investor intervention. It is the best benefit as investors can spend their time more efficiently instead of closely monitoring live boards all day long to place orders. So this is the end of the article 2. I hope you have a great day and see you next time for the article 3.